Okay, welcome back to the Mobile Mailbox Money Mastermind. We're going to share my screen here, log into our Zoom. That's every week here with my partners.
Hey, Anna, can you send that Zoom link to everybody in our group?
Yeah, sure.
Okay, so we are live on Facebook, YouTube, LinkedIn, here with Mobile Mailbox Money, Silvercrest Opportunity Fund, and Win Mobile Homes, largest dealer of manufactured housing in Arizona. Welcome to the Family Bank. We provide you a back office view of what we do on a daily basis, doing transactions. I was sitting there about an hour ago like, man, I wonder what we're going to talk about. And it's not even tough for us. Why? Because we have tremendous amount of deal flow. A lot of people got to figure out what they're going to talk about weekly. We do this weekly every Thursday, and always fresh content, fresh opportunities, and fresh potential investment for you to earn a secured position in exchange for a double-digit interest rate and a collateralized lending opportunity. I'm Alden Guajardo. We've done over 350 doors, raised more than $15 million in private capital in the local market of Arizona. And with our success, we now have new strategy into second liens on single-family residents at 65% CLTV or less, providing us sufficient equity cushion to feel comfortable within our investment strategy. What have we got going on lately? A little bit of house cleaning. We passed $2.3 million in capital and business received from Business Network International. Creating and passing new milestones with our membership in BNI Arizona, where the connectors hold the manufactured home category in the group. If you're in the Arizona market, come by and visit us every Wednesday at Orange Street Golf Course, located in Scottsdale, Arizona, Wednesday at 11:15. So that's open invite, 90 other business professionals in that room. I think last year we passed over $10 million in business. So real business, real transactions going on. Recently, always bring up Arizona Real Estate Investors Association. I was talking with my father, one of my partners here, about Mike Del Prete, who owns Arizona Real Estate Investors Association. We have a great relationship with him professionally, and he is running for city council here in Arizona. So to be connected and have influence, is of utmost importance. Not only that, but being transparent and open and honest, doing business with the individuals like, and trust is easier said than done. So we're happy to be connected to the largest real estate investment association in the nation. We've been to multiple national note investment conferences, have multiple podcasts and other educational content online. So that's just a quick little house cleaning. Last week, we contracted our batch of 12 manufactured homes, brand new 2023 models. And I think we're closing here on Friday. We'll get 6 months of rental concessions in our flip strategy. And hopefully we make at least 10,000 a door. I'd love to make 15 to 20. We'll see how it all shakes out. Those positions were short-term finance availability at a $40,000 capital requirement in exchange for a first lien position and a $333 a month payment, $333.33, providing a double-digit interest rate for a 1-year term. That contract will likely mature within the time period, as our objective is to flip the property sooner than later via seller carry finance. And as we vertically integrate from there, we bought the house, raised construction financing, drafted at a 1-year term, provide a monthly payment, find an end user to now buy that home, right, for more than what we bought it for. Really, we're trying to exit at $50,000, $49,900. At that point, that construction lender will get a first right of refusal of the seller finance note that inadvertently comes available. We seller finance at 14 and 15%, creating a note that's double underwritten, bank quality positioning and first lien, and providing ability to repay by the borrower. And at that point, that note becomes a bank quality asset, and you either have the option to get first right of refusal of that note or go liquid from that point. But that's kind of the vertical integration of those properties. As we exit, we estimate each property to cash flow about $500 a month or more, depending on how we structure that, whether it's a rent to own, seller finance at, our agreed upon rate, or, kind of nimble in that accord. Sean Gibson actually found that deal. He's one of our associates that's a deal finder and investor relationship specialist. So that's just kind of how that deal is developing. We're very excited. I think we have like 5 contracts out right now. We had a couple people drop out here and there because of liquidity issues or, needing to structure it a little bit different. So, those, we still have some of those immediately available. 40,000 paying $333 a month. I'm just going to touch lightly on those properties. Long Haven Estates. Let's see if I can do this correctly.
And one thing to just note on those that was not mentioned is those houses liquid are probably really worth $65,000-$70,000 each. We're getting them at a deep discounted just based off our relationship. So there's a huge opportunity for an investor to come in with real equity on a specific property.
So why is that? Why are they worth $70,000? Is that just opinion? What is the replacement value of a property like that?
Try to go buy the same property and go through the cost of placing it at a park. You're going to have $70,000 to $85,000 into that same exact house. So to provide financing or to provide construction lending at only $40,000, we're selling them at a bit of a discount just because we've got a volume amount of inventory. But we're going to continue to raise our price as we start getting sales. So our introductory price right now is just under $50,000 on the retail side, just to get a little bit of inventory going. But we're going to immediately raise that price and get closer to the $60,000, $70,000 mark is where they actually should be at. Plus is timing. We're in the market right now, the 55 and older market. Arizona weather is amazing in October, November, and keep moving forward into 2026. And now's the time when the 55 and older people are out looking for inventory and deals. So this is probably one of the best package of deals that we've bought in our history of 8 years of buying inventory. Banger.
So, we picked up 11 of these, and if you caught that correctly, just in the conversation that we had, means we bought them at $50,000 off. The owner who sold us these properties lost $50,000 a door. He lost $500,000 selling this stuff to us. Why is that? Well, his lack of sales staff, they had some change in management, and our niche market expertise in seller finance strategy, creates a perfect diamond in the rough opportunity. So that's 11. So we picked up, I think, 5 in the fund and, another 4 in private investors, as well as, have the availability to exit the fund positions and sell that to another private investor. So very nimble in that accord. Not sure if Jason's still on here. We were going to slide in a couple of these second liens, but we're doing one on Birchwood. James, do you have that address? Or maybe we'll leave that for another time. It's a $100,000 note, second lien, that we're pledging at a double-digit interest rate for a 3-year term. You could either buy that as a passive lender, knowing that us as the operator, we step in any case of non-performance that happens to be, in the Arizona market. So if the second lien, if that borrower and the first go non-performing at no cost to the investor, we garnish a fix and flip loan via hard money, pay off the first, pay off the second, and pay you off. And then we go earn our additional return on investment because of the equity cushion, walking into immediate equity within positions like that. That home's here in the Arizona market, and we're doing that in other investor-friendly markets with PLOC loans.com, private home equity lines of credit. And the difference, with a transaction like that is it's strictly asset based. So if we're talking about a HELOC, traditionally people are going to get qualified for their income and make sure that they have the ability to repay, whereas we feel comfortable and legally available as the open-ended private home equity lines of credit. If it's open-ended, they don't have to fit ability to repay. What does that mean in layman's terms? That means it's strictly an asset-based loan. So that loan will be based off the equity in the individual's property only, not so much having to fit the ability to repay. And the open-endedness allows us the availability to do that. And see Jason coming back on now. We've got a couple other first lien notes, but I'd love to talk potential. Jason, I know we're rolling out some new marketing in some of our desired upon markets where we deem risk mitigated. It's possibly a move to market. Those are markets I think we're opening. Arizona for sure. Florida is of potential. The Carolinas, we wiped Texas off the board because of the cap and stringent criteria they need for lending. Talked about Vegas, but Jason, appreciate having you on the channel with us today. If you could, maybe you could give just some input.
Yeah, sorry, my signal is not the greatest where I'm at today.
All good.
Yeah, so are you wanting to talk about markets?
Yeah, let's do it. Let's just open up the second lien conversation, and then I'll talk at the end about another seller finance note that we're doing. But just happy to have you here today.
Thank you, sir. Yeah, we try and stick to markets that are good, obviously good flip markets, because if you end up having to take these things over, you're going to be in a rehab situation. So there are some factors in that. I think you just mentioned that Texas, unfortunately, the legality of doing it there is very constrictive in terms of fees and that kind of thing. But for the most part, we're really looking at North Carolina, Georgia, Florida, the Vegas area, obviously the Phoenix area. There's some other states that we are really looking at in terms of like Tennessee, the Nashville market, but Tennessee's might be another prospective market. You'll notice the theme in all of these states are not necessarily completely landlord friendly, but they are not prohibitive of investors coming in and buying property and creating kind of a mess for us. So, we're looking at 7 or 8 with the potential of maybe getting into roughly 15 at some point. But again, each state, we have to go through the legality side of it, determine, if it makes sense to do, make sure our funding partners are protected. But this will be interesting as we start rolling out new states. Obviously, you create a windfall of more potential second liens. And so we're very, very excited about that process.
For us all collectively on here today, this is the scalable opportunity. Buying, fixing, flipping a bunch of properties, it has its challenges, and we have those expertise at the end of the day, but really scaling the lending. And that's where we've jettisoned from our primary business, seller financing, and now becoming more private lenders with the arm to lean on for fix and flip. How did we come across these deals, Jason? Were we trying to buy the house to begin with?
Yeah, that's our business, right? That's what we've been doing collectively for, I hate to say, combined how long we've all been doing this, but yeah, this comes from a need. We're fix and flippers, and we've been in the real estate business for, on our side, 30 years. You guys have been in it for 25 combined. We're 50 plus years together into this thing, and it comes from a place of, investing in real estate. And we're coming into a real estate cycle where, the stars are kind of aligning, where folks have a lot of equity in their house. They have really good first interest rates, but the economy's getting bad. And it doesn't matter whether you only owe 25 cents, 25% of the loan to value on a mortgage. If you run into trouble making that monthly payment, that whole asset is in trouble. And most everybody, from our end, we haven't run into anybody else doing this. Not one other person from hundreds of clients that we talk to has said somebody else is doing the exact same thing. Our goal is to try and help folks So this service comes out of the need of trying to help folks keep the equity they have in their house and just get through a bad situation. So it's a great, I mean, obviously we're doing our civic duty because we're doing something that nobody else is doing, but we are in a prime position to scale this thing to Wall Street levels. Depending on where the economy goes, obviously that's going to be a big factor. But if the economy keeps getting worse, from this side of it at least, we get into the multiples, that come with fixing a big problem. And that's basically what we're doing. So it's an exciting time. It's not really, I hate to use those words because it's not exciting if you're behind on your mortgage, but for the most part, you really only have a couple of options. You give the keys back to the bank, it goes to foreclosure, or you sell your house at a huge discount to an investor. And these are folks that don't want to sell. So we're giving them a solution to solve their problem, give them a year or two to get back on their feet, refinance, keep their equity. And, if it doesn't work out, we're there for them as well.
James, why are people told not to invest in second liens?
That's been an age-old situation on investors and investor education platforms. We've always been told only invest in first lien positions because that's where you get your greatest guarantee. But here's what happened, obviously, over the last 5-7 years. What interest rates shot down to 2% and 3%. Values of properties with Blackstone coming in, buying up the market. So Midwest markets, which has been the big traditional investment strategy, blew up, went from an average $50,000 home sale to $150,000, $200,000. So now the people that paid $50,000, their home's worth $250,000. And guess what? They've got a 3% loan on it. Who's going to sell that across the country? Nobody wants to sell that. That's the big thing. So it has created the advent of a secondary loan opportunity because there's so much equity inside the property. You have that much equity, you have room, strategic room for a second lien investor to come in with intelligence to validate and verify the lien position in the current situation with the specific owner and make a strategic second lien investment that's just as strong as the first lien investment because of the equity.
And another thing, fellas, that I think, many people may not recognize, but to get these kind of returns, the average person cannot access this unless you have $1 million with, like you said, Goldman or Blackstone. And to have the ability to have a second position covered by equity in a mortgage and to earn 10% or 11, 12%, whatever it is, it creates a tremendous opportunity for the average person that's got 30 to 50 grand that they want it to be secured, but they also want a decent, interest rate. So this is giving a lot of folks an opportunity that just, unless you've got massive investment capital, most people don't have access to it.
So I think, entry level, it's great to have that benchmark. If you're not big strategy, big intelligence into note investments, it makes sense. Yes, don't invest in second liens on your own. Go and buy just some second lien when you haven't been doing this for a while. With our expertise, we're providing you a literal bow of acquisition strategy out in the market, and you're hitching your cart to intelligence, strategy, boots on the ground in a high equity cushion position. If we were lending on a second at 95% loan to value, that may not make sense. It doesn't make sense at the end of the day. But knowing that we have our due diligence check boxes in order to validate the first, make sure there's no escalation clauses, we're going through a licensed attorney or title office, getting an inspection on the property, validating that the house is there, that is actually an asset that's physical out in the marketplace. At that point, that's where the risk comes in. There's risk in investment, but taking a strategized approach towards the risk is the difference between a successful model and a non-successful model. And at that point, we know what's the best case scenario, what's the worst case scenario, and all items involved. And we've agreed, okay, that's a hedged risk out in the market. You have to take a risk at the end of the day. And knowing our intelligence and due diligence check boxes are built in to understand worst and best case scenarios, I think is really sobering for a lot of individuals that have been told historically, don't invest in second liens. Listen, we have all the boots on the ground and contractor staff. We were trying to buy the property originally, and the need is now more important than ever. Debt is at an all-time high. People are suffering from high grocery, high gas. Cars are potential going at record highs to repossession. All of those are factors of why this product is truly the biggest scalable opportunity in the nation. And with our returns that we're benchmarking, to find an alternative out in the market that fits that income-oriented investment really doesn't exist. You're either hedging on an equity multiple and a 3 to 5 year exit, or putting money into tech stocks and things of that nature. Well, huge risk in speculative appreciation, huge risk in volatility in the stock market. We saw $2 trillion or whatever trillions got wiped off the market the other day. It was a full red program going on across the stock market, where this is contractually agreed upon returns. It doesn't just go away. It's a collateralized lending opportunity that we have brought to the table with a bow, and I think really, to understand that these people came from foreclosure lists, and ultimately we backdoor that acquisition when they don't want to sell. We end up lending the money collateralized by the second is truly eye-opening, I think, for a lot of individuals.
I think the big thing that we need to understand, and we do understand, there's tens of thousands of note investors that are out there. They've gone through a training. The historical training over the last 10 years is, hey, you got 20, 30, 40, 50,000, you could buy a note. Those notes are gone. They're completely gone. Rodney Madison's on this Zoom right now. I think he probably went through that same event. But we've touched hundreds of note investors that have capital, but they don't have 200, 300, 400,000. So where do they go to lend out 20, 30, capital that's under 100? Where do you go to lend it out? You've taken an education class, you took that premium class, you paid a fee for the education, and you're ready to go, and you're trying to bring in other partners and other people. And pricing went to 250, minimum 200, 250,000 in the Midwest market. Arizona average price is 400 to 425,000. Florida blew up, Nevada blew up, California has always blown up. Texas market went to 200,000. You can't find a $50,000 note to buy. Where do you go? And that has created additionally the advent of the opportunity of two major things: second lien investments with high equity in them, and manufactured home notes. Our business model for manufactured home notes has completely skyrocketed because of the fact that you have seasoned, savvy note investors that have been properly trained and understand the components of a note, but they have nothing to invest in unless they look at second lien investments and manufactured home notes. So they kind of go hand in hand. It's all relative to what is the collateral and what it looks like. Rodney, what do you think about that? I know that you've been on this Zoom for multiple weeks, and that's your strategy, correct? Or am I incorrect?
Absolutely, James. You hit the nail on the head. It's a struggle to, you deploy your capital and all these other investors. There's not enough money to go around. So you have to try to use OPM, and now the goal is to go a little bit higher to get quality products. So you hit the nail on the head there.
Because I have talked to you on multiple occasions and other note investors, really the number is like 40, 50, maximum 40, 50,000, because you want velocity. You don't want to burn it all on one deal, right?
Right. Yeah. I just find that, especially when I'm bringing in new investors, that's their sweet spot around that $50,000 mark. But as time goes on and they get comfortable with what the process is, they can up it because most of the people that I work with, they do have more capital. So, but it takes a little time to grow that trust and that and find the right properties.
Yeah,
Notes.
and the kicker is everybody wants to leverage their capital. Who wants to put all their money in one basket? We're always trained, don't put it all in one deal or one investment strategy. We want you to spread it out. So the only way to spread it out is you have to find the right price on different investment strategies. It's got to be value priced. And
Absolutely.
That's why we really started looking at second lien investment deals with high equity, because it goes back to single family homes, because everybody's been trained primarily invest in single family homes, but you can't buy a first lien position today. I don't think just about anywhere in the country can you buy a quality first lien investment in that $50,000 range. I don't know a state that you can do it, because Blackstone came in and just carved out the entire country and turned the entire country into a rental market.
We've got a couple new people on here. This is built as uninvolved or as involved as you'd like. We're going to just pump the brakes for 1 second here. Any new input or questions? All good, all good. You know, a lot of different, strategy that goes into providing diversification. You go to your FA and they can provide a myriad of mutual fund investments, bonds, stocks, blue chip, all the above. Or, you go into a insurance, equation. This is the diversification in real estate, and the people that know real estate and lending, this really starts to make sense. And to hedge across multiple affordable assets is of utmost importance, as we mentioned here. It's easier said than done trying to hit an equity multiple on a $10 million apartment complex. And when you go to exit, it's contingent on an institution buying out that program or a larger hedge fund. Whereas these, our liquidity in the affordability of the asset is something not to paint over by any means. Hedging on assets from 50 to $500,000 total, or, up to $1 million on a single family property, which $1 million across the nation is pretty average at the end of the day, just shows that diversifying across multiple doors and making your capital go farther, across hedged assets and not need institutional exit really starts to create comfortability. I know a lot of people are scared and uncertain about what's going on out in the market. They're hearing speculation from unintelligent sides and sways and CNN and ABC and tweets going out. This is where the market is leading, and to follow us, not only us, but we follow other institutions that are telling us, kind of signaling where the market's going, not only in second liens and the people that are finding huge appetite in these second liens, but also in our primary strategy. Warren Buffett's the probably most prolific investor in the world, and he's always historically been a winner. And when he liquidates or makes a move out in the market, people follow that. Well, you know what he hasn't liquidated and has actually doubled, tripled down on is his investments in affordable housing and manufactured homes. People are told not to invest in second liens. People are told not to invest in manufactured housing. Well, the most prolific investor in the world is actually taking one of the biggest bets in manufactured housing, owning Clayton and Cavco, two of the largest manufacturers of mobile homes, owning 21st Mortgage, which will take the long-term note. He'll private lend essentially on manufactured homes, personal property. He'll also buy the parks to have the homes inside of them. So well diversified across, the asset class, because he sees, affordability, they're saying, is at its lowest than ever, literally ever. And to be providing a solution to affordable housing and keeping people in their homes in a time when it's needed most, that's where our true diversification and creating a bulletproof portfolio. What does that mean? That means wealth preservation. Everyone wants to make the most money, but at the end of the day, as long as you can get by without losing a dollar, that's where the rubber meets the road. It's not about making a 2x equity multiple or, making 25 to 30% on your money. If you're chasing those returns, it's probably not the meeting for you. You could probably find someone out in the market to trade your stocks. But that being said, at a double-digit interest rate or investing in the fund, this is where it's at. And I've been to multiple national note investment conferences, and I think a lot of people agree. Looking for alternatives is tougher than ever. And having a mastermind like this, open format every week, we've changed it to this 1 o'clock time here in Arizona. Know that this is weekly and it's as involved or uninvolved as you'd like. I'm going to just share my screen here and talk about another deal that we have that's actually came to my attention just this morning. Let's see real quick. So these are the Long Haven deals. Let's talk about lot 107. So I talked about my Business Network International meeting earlier, and I hired a Spanish-speaking sales agent who helps us capitalize in manufactured housing sales as a licensed sales agent, but also speaks Spanish. We have Anna on here as well, who helps facilitate that side of the business. But Alan, actually our sales agent, has this property currently under contract, and I'll just talk about the numbers real quick on what this looks like. So this is a property that we own in our portfolio. We're selling it's contracted at $135,000. James, what did we buy this house for?
We bought it for about $70,000.
We paid 70. How much capital do you think we put into it?
We put another 20 into it.
So we're probably all in at around 95,000 upon exiting. But I mean, to find a double wide, this is a 4-bedroom manufactured home in a family park.
It's about 1,600 square feet, so it's one of the larger ones.
So it's, banger.
2006, newer ones.
So vaulted ceilings, 1,600 square feet, 4-bedroom in a family park in the West Valley. This property is not even finished, and we already have it contracted. The buyer's applying. So why am I even bringing this up here? Well, not only are we going to make $40,000 on this property, not to skate over that by any means, but as this investment strategy, the long-term cash flow, not the fix and flip program, but the acquisition of a note just like this on a quality collateral to a deserving borrower, this home is actually going to net us monthly with no banks, no insurance, no property taxes, maintenance, toilets, termites, tenants. We create an owner at $135,000 property value. They put $7,000 down. And if you have a mortgage calculator, you feel free to grab that out and do your calculation here to potentially find out what a return on investment would look like. But $135,000 this buyer paid. They put $7,000 down. The unpaid balance or acquisition of this seller finance note will be $128,000 at a 20-year term for $1,685.49. Right? This buyer will match or beat market rent for a comparable property like this in the area. And the investor, ding, 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 the investor will actually make over $15,000 a year. To try and replicate that in a long-term real estate investment strategy is literally non-existent with no banks. No banks, no loan. You could buy this today through your IRA, your solo 401k, or really just an LLC for personal investment, or a trust where you can potentially, like Rodney mentioned, do some form of partial where you use other people's money in order to buy this note because it's such a high yield position. This property could be cut and sliced and diced in a myriad of different ways. You could also invest in the fund where these positions are all absorbed or absorbable. Every month we've got like 5 to 40 positions, meaning we could put $50,000 up to $1 million to work in as little as 30 days. And I see a couple other people have joined here. Shout out to Smitty. Smitty's actually referred a couple people to us in the past, as well as just recently we consummated a deal with one of his associates. And I think he's consummating a deal as well. So, wide breadth of investors that join this meeting at any given time. Why do they join? Why do people join this with us, James?
I think that, and it's great to see Smitty and Rodney and other people that I've seen as note investors. What we come to realize that investing in real estate notes requires an extensive amount of capital. You become really a relationship person trying to find out and source out the best deals while you're building your warm network. You're bringing in other people that aren't savvy real estate investors and note investors, and you're having to teach them and educate the platform. So we get a lot of people, including us, we go and seek out education on a regular basis and learn and get more attuned and abreast to what's going on in the market and what deals that are out there and what's available. We could spend $10 million if we had it. So at the same time, while we're learning, we're bringing in other people to help bring in capital to help us buy more notes, and that creates a wealth strategy. That's the primary wealth strategy. Raising capital with friends and family and other people to do more deals and consistently bringing in to get that return on investment, but to get that monthly cash flow that will create a high net worth wealth.
The thought adjacent here is we're almost creating a bank. At the end of the day, you hear people talk about creating a family bank and investing all together. In order to grow the opportunity, you have to find other family members or capital investors that want to join in on the fruits of the labor in order to properly scale and literally to be having these positions, banks positions. You're almost joining the family bank here today, creating true wealth with the scale and, risk mitigated lending we have here. I'm going to open it up just one last time here. If anyone has any input or questions, I know we got a lot of deals and contracts flying out there. So just little feedback if you have it at all. A lot of capital going back and forth. We just sold and netted, I think, $50,000 on a flip that we received $100,000 wire yesterday or this morning. We had 6 contracts go out for $40,000 positions, paying $333 a month. In passive diversification. And our fund has like 1.54 million working right now. I got a financial update from my accountant. On that note, it's not just us even sitting here today that's a part of this program. We have in the Arizona market 7 in sales, 5 in management. We have 2 investor relationship specialists. We have, I think, 6 VAs now. And the staff that Jason and Todd bring to the table shouldn't be overlooked by any means. Jason, how many people do you guys have involved in your team?
Oh my gosh, depends on where you're at, but we got a network of, 400 around the country that we use depending on what state, area, and city you're in. So yeah, we've been building that network for 20 years.
So what you're doing right now is like being at the bottom of Mount Shasta and putting on binoculars, and you're looking at our team at the top of the mountain. So we're providing you that jettison to get up off the couch, either from a residual educator or someone that has money in a money market account or sees that Trump made a new executive order providing investors their 401ks to invest in alternative investments, or you're just Googling alternative investments. This is the view and binocular vision of our vision exploring this market and scaling it to $50-100 million. And we think we could get to that. James, how quickly do you think we could potentially get to that once we turn all the lights on? We're doing our first deal here this week, but what's your opinion of that?
I mean, we could, with a little bit of velocity into 2026, we could be deploying 5 to 10 million a month with the right strategy. We brought on Jason Roberts, who's on right now. The volume of second lien investment, quality second lien investment opportunities is tremendous. The key is number one, validating the property. And number two, making sure that you're licensed properly to actually do the specific strategy, which is second lien investments requires specific licensing in each one of the states, which is a key critical item. So it's looked at a more stringent situation. So we haven't completely rolled it out 100% in the states that we want to roll it out to until we get the proper licensing. But once we have that done and get it underneath our feet for a little bit, I think with it we'll have massive deal flow and massive opportunity. I kind of associate it with the same strategy as what we do on manufactured homes, which are first lien investments, but you don't own the land, but you're still getting a quality lien position note that has a high return on investment for the specific investor. So we're kind of trying to match that same kind of component. At the same time, it's just a major opportunity in today's market with what's going on. Major opportunity.
So if you're unfamiliar with kind of our program and what we do and, you know, where we post our notes for sale, I put a quick message in our chat here. If you've not visited our website at mobilemailboxmoney.com, do yourself a favor and go and create an account. You can check out live updates of stuff that we bring to the table for live notes. There's actually a chat box. You could actually ask questions. Don't hesitate to enter in your information. We won't blow you up by any means, but this provides you a little bit more of transparency out of what we do, you know, the family nature of our business and why it's an opportunity. There's a couple, videos that you can watch as well. Mobile Mailbox Money is for anyone, the layman, the intelligent investor that just wants one note with one investor participation. If you find yourself blessed to call yourself an accredited investor, you could invest in the fund today and start earning interest in as little as a 30-day program. That's for 506C offering accredited investment, providing a 10% return for 1 year, paid monthly, a 12% return for a 3-year lockup, paid quarterly, or a 14% return, newly originated 14%, woo, 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 at a 5-year lockup, paid monthly for an income-oriented investment strategy that's backed by the power and the regulatory factors as a accredited 506C fund. And I have the availability to publicly market our rates of return because we paid the fee in order to properly offer investment strategy to you today. So, like I said, if you haven't visited those websites or you're even more curious, say you want to see more stuff, this Zoom's not enough, the websites aren't enough, go to YouTube, type in my name or Mobile Mailbox Money or Silvercrest or Win Mobile Homes. Really, you could type in Mobile Mailbox Money and see 900 education videos, blogs, podcasts, interviews with industry magnates like Mark Monroe, Eddie Speed, Patrick Franz of the Note Investor University, Mike Del Prete of Arizona Real Estate Investors Association, Nate Hare, who we work directly with Directed IRA. We just came back from their Alternative Asset Summit. I could literally go on, I think, for half an hour. The amount of people, Kevin Shortell, Fred and Tracy of the Note Investor, the noteinvestor.com, all the above. I hate to waste too much more of your time with our accolades and things of that nature. If you've yet to reach out to us, we have sales staff immediately waiting for your outreach. Call today at 602 888-CASH. That's one step closer to financial freedom. What do we call that? Mobile mailbox money. We appreciate having each and every one of you here today. Next week, same time, same place, same link. Please don't hesitate to join or reach out. Appreciate having each and one of you here today. Bam.
Double bam.
That was good, fellas.
Well, that's it, people. Appreciate you viewing. Give us a ring. See if I can end this.